that's the case. And at the heart of it, I think it's really about expectations on sustainability of the growth trend in the US. Of course, like Nikunj pointed out, I think the bigger concern for them is how the trade war issue kind of hits home when it comes to the growth momentum that the economy has been showcasing. As also, in the wake of that, if the Fed indicates that they will hike rates faster than expected because they believe that the economy is moving towards an overheating zone, then the markets believe that would be a bit of a premature move. And so the Dow was down 7% for the month. Actually, just the single day fall has been fairly significant. 2.5% on Dow, S&P 500 down 3%, and the Nasdaq, where the valuation froth has been more significant. That index is down about 4.5%, and you had the FANG stocks particularly give way in yesterday's session. So all in all, I think it is a worrisome situation. The markets are being volatile, and we'll have to see whether you'll get more such bad days into the near future, into the medium term, than good days in the markets. That typically happens to be the case when the markets start pushing past historic valuations. Just one more point on the CBOE VIX, which has surged over 100% this month. The level is 25 on the CBOE VIX, and I think that just sends out the alarm bells on being more cautious than not in an environment like this, because there is a fair amount of uncertainty with regards to what you're buying into. Is it just high prices, or is there growth momentum supporting that? We had the legendary John Bogle yesterday all day long on the channel, and this is what he had to say about his views with regards to investing. He of course spoke more about passive investing versus active investing, but generally his thoughts about how to approach the market at these levels.
In the long run, it is investment return that drives stock prices. It is corporate earnings and corporate dividends. And so the first two elements of my equation are the earnings growth that we expect to have in the future, and you could be wildly off on that, but you're pretty confident that in almost all cases it's not going to be more than 10% a year, and it's not going to be less than zero. So there's a narrow range for at least my predictive system. And then you look at the dividend yield, and the dividend yield again is very important. But right now it's less than 2%. Let's call it 2%. So if we get earnings growth in the future, Jeff, of 4%, let's say, maybe 5%, you'd get a 6 or 7% investment return on your securities. And that's what the market will gravitate to in the long run. However, speculative return is the other part. And speculative return is the valuation of your investments. Take a simple example. If you buy into the stock market when it's 10 times earnings and sell at the end when it's 20 times earnings, that's a 100% increase. And over a decade, that's 7% a year, even more than the investment return that I just gave you. So what's to be said about speculative return at this stage of the U.S. market? And that is, I confess, I don't know.
Okay, that's the legendary John Bogle talking about the investment outlook that one needs to carry, especially during volatile times.